Thank you. Hey, Rick, how's it going?
Good, Andy. How are you?
I'm doing well. For those listening, just give us an introduction about your background and what you do.
Yeah, sure. Well, first of all, thanks for having me on. It's nice to see you. Secondly, yeah, so I'm an administrative lawyer. I've been in practice for about 20 years, and I've been in the markets since the late 90s. I took a little break from the practice of law and traded both my own account and professionally for about 5 years. And so I think of myself as an armchair market economist.
Okay, very good, very good.
Yeah.
I know you more as a trader, if you would. Just to give a little bit of background, I think it was 2015-ish, 14, 15-ish. We were chatting and you were launching some managed money or a fund of some sort, trading currencies. So for all those that are listening, that's Rick's background. Well, previously, we had discussed offline about this whole idea of dollar dominance, the US dollar losing its reserve status, or you hear that a lot now in financial media with all the printing going on, if you would, which there is certainly a lot of. I don't think we would disagree with that. And by the way, I don't think we disagree at all. But anyways, we talked a lot about just what's going to happen with that dynamic. And what I appreciated about you take a different view, but it's a nuanced view on what you hear a lot of people say. And so I just wanted to work that out. So just give us a 30,000-foot view of what your belief system is as far as that reserve currency status, or how that works. And yeah, and we'll just go from there. So
yeah, sure. No, thank you for that. Look, I would say that I started out pretty highly influenced by versions of the Austrian school, and over time began to think of that more as a political theory than an economic theory, in the sense that I didn't see it as describing current market reality. And if I look at economic theory, and one of the things I want to get out of the theory is the ability to explain the present and predict the future, I came to the view that that particular paradigm didn't do as good of a job as what is sometimes called MMT. And I sort of moved away from that and more in the direction of MMT when I felt like it provided both a better explainer and it had more predictive power in terms of what the markets were going to do, and the relationship between currency as debt and the markets generally. So
if I can interrupt real quick, what do you define MMT for?
Yeah, look, I'll leave that to academics, and I would just say, if you want to read about MMT, you can read Warren Mosler. And probably there would be people who would critique this characterization, and I mean to use the word loosely, but basically just the notion that if you want to understand the way banking works and the way the markets work, you have to be open to the idea that the central bank in the United States, as the issuer of the currency, which has the world reserve status, has the ability to, I don't like the words that coming to mind is to print money essentially ad infinitum. I don't like the way that sounds, but I don't have a theoretical basis at the moment for coming up with something else. And we'll talk about sort of why I think that is. The short answer would be that currency and debt are essentially the same thing. And so we'll talk about why I think that is, right? Yeah,
Please.
Why I think that is. Yeah, and with respect to the question of de-dollarization, I would just say a few things. Number one, obviously that's getting a lot of press recently. And I think it's getting a lot of press because there's a resurgence of the BRICS coming up with proposals for basket currency, developing strategies for trading in goods and also in petroleum, especially in ways that don't involve the dollar. And many people, have come on television and said that that is a bellwether for a future in which the dollar is not the reserve currency. And look, I'm not an expert, but the way I look at it is fairly simple, which is when you think about what you're trying to get out of your currency, mostly you're interested in political stability of the issuing country. And when I think of Brazil and Russia and India, possibly Iran and China and South Africa, political stability is not what comes to mind.
Right.
And so, yeah. And so the idea that, I would trade my US dollars for Chinese yuan tomorrow, because I have some countries that are doing in runs around the dollar in the petroleum trade, to me is a little bit far-fetched. The other thing, though, just practically speaking, if the world wanted to give up its dollars, you have to think technically about how it would do that, right? How would it do that? Well, how does it get dollars? Well, it gets dollars by selling Americans things, right?
Right.
And so in order for it to give up those dollars, it would either have to stop doing that,
which would crash their economy.
Yeah, I mean, to the extent that those countries depend on dollars, they would need to come up with something else. But more importantly, they would have to come up with another customer for their thing.
Right.
Okay. To put it in macroeconomic terms or in a broader perspective, the United States would need to run a trade surplus, a significant trade surplus.
So I'm writing notes here. So I guess your argument really is they have no other choice, or if they don't,
well, it's not just that they have no other choice. They actually want dollars. So when the Vietnamese make furniture, when the Indonesians make furniture and the Vietnamese make furniture, they actually want to trade that furniture with the American consumer.
Right. Yeah.
And when they do that, they express a preference in the commercial transaction for dollars.
For dollars, right?
Yeah.
Okay.
They buy and spend. They buy and spend in their local currency, all for the express purpose of reducing that transaction to US dollars.
Right. So, but why, I guess, why would they not change? Let's say if somebody offered something better.
Well, let's talk about what would constitute better.
So, yes. So I would agree with you, and I'm agreeing with you. Mm-hmm. Don't get me wrong, but I am somewhat playing some devil's advocate, because what the next question would be twofold. So, okay, and you know where I'm going with this. It'd be gold, or it would be crypto, right? So what if they demanded gold, or what if they demanded Bitcoin?
Okay. Yeah. So let's first decide whether we think that the next option would be gold or Bitcoin and not some other currency. So for example, when the BRICS are getting together, I think, and I admit to not being an expert here, but I think that what they're concocting, or what they pretend to be concocting, is a competitor to the IMF's SDR, right? Yes. So there's a basket currency which is called special drawing rights, and okay, I think there's the what's in the imagination, at least, is a BRICS version of an SDR. Okay, so it's not
I would
gold,
agree.
right? So it's not gold, which is finite, and it's not crypto, which is chaotic, right? It's chaotic in the sense that you want currency to be a store of value, which means that volatility is bad, and
which crypto is volatile.
Correct. Right. So let's agree that while in theory cryptocurrency is interesting, it certainly isn't money. Not yet. Okay.
Not yet.
Right.
And I am a very, just for the record, I'm a believer, but not really. I'm an observer of crypto.
Right. All right. I like the idea. I like the idea of being able to wrest political control for the issuance of currency from central banks, the most powerful institutions in the world, and compete with monopolists in the issuance of currency. I love that idea.
Yeah.
I'm a libertarian at heart. I tell people that I'm a libertarian on a good day and an anarchist on most days. So I think it's
Right.
so yeah. So I think it's great, but it's not currency.
Right.
Okay.
You can't
And
go buy a cup
also,
of coffee with that right now.
right. So let's not talk about Bitcoin as a meaningful competitor. Okay. It's not currency.
Okay, so we eliminated that, but then gold, and let's say the BRICS is which from what
So hang on. So,
okay.
so before we decide whether gold can be a meaningful competitor, have you ever been involved in looking for and finding and extracting and transporting gold? It's quite expensive.
Right. Have I ever? Yes, but for the sake of this argument, no.
Right. It's quite expensive. So, so in general, when you're talking about currency, do you want the ability to create your currency? Do you want that to be expensive?
No. And also,
what about transporting it? Do you want it to be expensive to transport? Like, do you want to be fleeing medieval Europe with a horse and buggy with your buggy loaded down with currency?
Right. But what if you can do that when it's all digital? So you have it in a vault in Knoxville. Yeah. I mean, I'm just, again, theoretical argument, right?
Look, the reason Bitcoin is interesting is I think someone said it's better at being gold than gold. And for that reason, it's interesting, right? The question is finite versus infinite. And to me, I think the burden is on the crowd that insists that it be finite, okay? And the reason why the burden is on them is because the proliferation of currency has inured to the benefit of the citizens of the issuer, not the reverse. So when you look at Reagan blowing up the credit markets and the debt, you also see GDP blowing up. So what you would have is a profoundly deflationary environment if you went to a finite currency. And some proof of that is what's happening with the debt ceiling discussion right now. If the debt ceiling, first of all, the debt ceiling is a fiction. It's a fiction in the sense that all laws are fictions. They could be changed tomorrow. We could easily eliminate the debt ceiling. We act as though it doesn't exist anyway. It's political theater to pretend that it does exist. If we decided tomorrow that it was going to exist and we developed a posture of political austerity, that would have economically devastating effects on the market and the real economy. And everyone would get religion very quickly. They would get religion very quickly on their idea that the government should be run like a household, which is nonsense. It's nonsense because households can't print their own money, and the neighborhood doesn't want the money that your household could print if it could, right? So here, so to me, the more productive conversation is really to put the burden on the person who believes that our current situation is problematic, right? So for example, people say that the notion of the debt to GDP ratio is a threat to the global dominance of the US dollar. And I would simply say, oh, well, if that's true, then you're going to need to look at the United Kingdom, the European Union, and the Japanese yen as competing currencies that present very significant debt to GDP problems. And yet no one is talking about reducing their trade in Japanese yen, for example, even though I think they run about a 235% debt to GDP ratio, right? So debt to GDP ratio is not the thing. In fact, what happens is, and you tell me if you think this is wrong, when a person buys a treasury note, that is actually a demonstration of dollar demand. And the reason, okay, so if that's true, the more treasury notes that get issued, the more dollar demand there is. So that's a defeater for the claim that debt to GDP is dollar weakening, because debt can't increase without dollar demand increasing.
Right.
That's the opposite of Austrianism.
Right. Yeah. So I guess, but let's say, like, I have to think about that.
Yeah, that's a tough one. That's a tough one. So let me kind of break it down a little bit. If somebody in Australia, where I happen to live, says that they want to buy a treasury note, they'll take their 2% over, they're going to buy a T-bill. They'll take their 3% over 10 years, right?
Right.
And they're going to spend 10 grand. So what they do is they go to the bank and they turn in 15,000 Australian today in exchange for a promise that the US government will pay back 10,000 plus a little coupon over the course of however many years, right? So what is that Australian trader doing? What they're doing is they're saying US dollars in the future for the length of this bond is worth more to me than Australian dollars today.
Yeah. Okay.
So that is a market movement which demonstrably proves that debt equals demand.
Right.
Not the reverse.
Right.
So when the talking heads tell you that an increase in indebtedness will result in lower demand, they're idiots.
Well, okay, so let's say yes, but let's say during the Clinton years, I have two things for you. During the Clinton years, you had the bond vigilantes, right? So they're issuing all of this debt, and what were happening, interest rates were going up, which means debt was less valuable.
The debt being issued, yeah.
Yes. So there wasn't the demand for the debt while more debt was going up. So that's my first point. And that's just one instance.
Let me address that though. You can't issue it unless there's demand.
Okay, well, yes, you can't issue it like anything, right? You can't, so they're issuing it, there's going to be demand, but at what cost?
Right, it's whatever the rate is.
So it's a higher cost.
But so irrespective of the rate though, irrespective of the rate, the first question is, does debt undermine the currency? And in the case of the United States, the answer has to be no.
Well, over the past
No, but hang on. Years, but think about the Aussie transaction that I just articulated. There is no debt without demand.
Right.
The debt doesn't exist without demand. And that's because the dollar itself is debt.
Okay, but then yes. Okay, so then here's another issue. Explain this. Is quantitative easing when the Fed is selling bonds, or I don't want to say the Fed, but we're selling bonds. Whoever's selling bonds, and we're buying the bonds.
Mm-hmm.
So we are creating debt,
mm-hmm.
and we are absorbing the debt
with dollars.
Yeah. So
which are themselves debt.
Right.
Which means that the debt that you issued in the form of notes doesn't really exist.
Exactly. So what I'm trying to say
You're making the MMT point.
Okay. Well, I'm trying to work this out. Maybe it's a
yeah.
Okay.
The question that's interesting. I have
a question okay, go ahead.
Oh no, go ahead.
Well, okay, so no, you go ahead. I want what's the interesting question?
Well, to me, the interesting question is, why doesn't anyone care?
Why doesn't anyone care?
Yeah, because what you have are these talking heads who treat government economics like household economics. They talk in ways that utterly defy market activity, market behavior.
Right.
And so either they're right and the market is wrong, or the market's right and they're wrong. Maybe being simplistic, but that's what I think.
Yeah.
All right.
Okay. So let me give you go ahead.
Yeah. So when we talk about de-dollarization, first thing is, does increased indebtedness spell doom for the dollar? And the answer is no. Increased indebtedness is a sign of dollar demand. That's what I think. I'm open to correction. I'm not an expert, but that's what I think. That's number one. Number two, you have what Martin Armstrong calls the cleanest dirty shirt problem, right? Which is to say, look at the meaningful competitors and ask yourself whether they represent an alternative. And they don't, for various reasons. And we can rattle down the list, okay? So debt is not an impediment, number one. Number two, you have the cleanest dirty shirt problem. And number three, in order to divest yourself of all your dollars, well, you'd have to buy American-made goods. and you'd have to stop selling your stuff to America.
Which is not going to happen.
Correct. So now when you hear people say, oh, but hang on, let me put a little footnote there. Sanctions are stupid. Sanctions are bad in the sense that they're bad for the dollar. I think on balance, they're not worth it, okay, because they induce dollar avoidance, and the political outcomes are mixed, okay? So it's not the case that these bilateral trade deals or these little side groups with the BRICS, that's good. It's not the case that that's something that's nothing, okay? I'm not utterly ignoring that. I'm just saying, yeah, the mechanics of how you would de-dollarize, no one's going to do that, not in our lifetime. In order to do that, they'd need a meaningful competitor and for consumption, and they don't have one. And even if they did, think of this. If what they did is they said, you know what, we're going to stop selling stuff from America and we're going to buy stuff from America, you think that would weaken the currency?
No.
Okay, so can we just dispose of the idea that we're on the cusp of de-dollarizing? Like once and for all? Can we just put that out of our vocabulary?
I'm not ready for that, but I see
paradigm shifts come with difficulty. We learned that from Thomas Kuhn.
They're this is what I ask you. Okay, so this is what I think is the. I don't. Maybe it's the wrong statement. It is the interesting question, but this is what I see it is.
Okay.
The dirty shirt problem. 100% with you.
Okay.
100%. But can we say relative to what? The dollar is weakening relative to what?
Well, is it weakening?
Well, relative to real estate for the past 40 years, yes. Relative to oil for the past 30 years, 25 years, absolutely. Relative to buying a car, yes.
Well, okay. I mean, the absolute value of the dollar goes down, but you can't, I don't think you can really look at the absolute value of the dollar apart from productivity gains. So, you know, it's not.
Well, okay, so yeah, you can, because the 1970s, right? High inflation, low productivity, low economic output, but high prices, right?
Yeah. Yeah. So there are anomalies. There surely are. And
well, you can say that this is an anomaly now, because how much has the economy, or I should say, the economy's grown, but over the past, I would say since, I don't know, 5 years, how much has it really grown? Or maybe
well, I'd have to pull up the numbers, but what I would say is the dollar in 1976 was trading at 107. It's currently at 103.
103.
Yeah,
but that's
during the oil crisis in the late 70s, 78, 79, it was trading at 85. Okay. Right.
But that's relative.
The last time it was trading at 85 was February of 2000. Yeah, the last time it was trading at 85 was not 85. It got to 88 in March of 2018. Okay, what's the point? The point is those long range comparisons, they're not super helpful.
Well, they are helpful because it proves the point of it's relative to other countries, it's very stable, right? Relative to other currencies, it's really stable.
Yeah, but that's not a de-dollarization claim. That's the opposite.
That's my point. I'm not making my point is like, okay, I'm with you on the dollar. Dollar's not good. And to be very candid, I believe I'm there. Yeah. But relative to what? Relative to what? Relative to oil, relative to automobiles, relative to real estate, relative to food.
Mhm.
Yes.
So,
So
what's the
relative to what?
concern? Is the concern that it takes more dollars to buy the same food?
I would say as of right now, no, but probably in the future. But that's not a de-dollarization problem. I would say that's a production problem, which was your point.
Well, so, but I would offer the
say,
perspective though that, yeah, it takes more dollars to buy the same food. Okay. I've seen the chart
Okay.
from 1913. Okay. I have.
okay,
But I also know that I can earn groceries for a week in an hour's worth of work.
mhm. Right.
So I don't know how to do it. Like, I'm not a wizard, but I don't know how to do the math that gives you a kind of dollar value that is adjusted for productivity gains. But like, I think you have to. Now, certainly some assets inflate with the proliferation of currency, right?
Right.
I mean, real estate is the main one that we see. And
Right.
that's pretty simple in the sense that if rates are artificially low, then you have market participants
Right.
that you would not otherwise have. And, I'm not a huge fan of that.
Driving up.
Yeah,
Right.
not a huge fan of that. I don't think that, maybe I'm wrong, maybe I'm overlooking something, but I don't think that, being opposed to easy money, that doesn't do anything to my view of the market at all. Right.
Being opposed to easy money.
Yeah, I mean, I'm
Meaning-
relatively opposed to artificially low interest rates. But on the other hand, because the asset inflation is, I mean, probably the truer MMT-ish way of looking at it is to say, look, all you're doing is taking money from one pocket and putting it into another. And so you can complain, but it's only to the extent that you're a consumer of goods that you complain. If you were a producer of those same goods, you wouldn't complain. It would
you're making
all,
yeah, all it is.
All it is a transfer, right?
Right.
And so in that sense, it's fine. And the retail consumer is strung out because they're primarily debtors. They're not creditors. Like, if the cost of their resources goes up, if the price goes up, then they're going to make more money. But if they're primarily debtors, then they don't have that experience. And, I mean, I don't know what to say about that, except that, yeah, that's true.
Right.
Yeah, look,
I guess that's more of a moral problem, but yeah, I guess for the sake of this conversation and argument, I am with you. I'm just trying to poke some holes here.
No, that's fine. That's fine. Look,
I do think there's something to. I do think there is something to. You have to ask, and this is a complicated problem. I don't want to say problem's the wrong word. This is a complicated issue that too many people try to give simplistic answers, and that's what you're seeing right now. I
think the desire for simplistic answers is a function of the form of the media. That is to say, the mass media and the visual media, and also the need to create advertising dollars. So, people act on the basis of fear more readily. And so you can talk about de-dollarization and economic collapse and so on, and you don't actually have to make real arguments for that. But the other thing is, I think in one sense to talk about is inflation. And, I mean, obviously raising interest rates is inflationary. The idea that you would raise interest rates to stave off inflation is one of the dumbest things I've ever heard. I mean, you certainly reduce some buyers in the inflated assets. Like, I'm not going to go buy a house that has doubled in price in the last 5 years because now, instead of it costing me $3,000 per million, it costs me $6,000. Okay.
Right.
But that's not the primary problem, the inflationary problem that, let's say the Fed is trying to solve. They're trying to solve inflation with respect to all the other stuff we buy. And as you know, commercial paper and various other debt instruments is necessary for, are necessary for, producing those items. And so when you raise the cost of those instruments, you raise the cost of those items. And why? Like, I don't have to be Neil Kashkari to be able to explain that. So I don't totally understand why the Fed, to me, seems ignorant of that. They want to turn it into alchemy. If you raise interest rates, you're going to raise prices. It's that simple. I mean, if you're running a business and you have to make payroll on day one, but you don't get paid until day 97, you're going to need commercial paper. And if that commercial paper goes up in the cost of it, then guess what you're going to do to prices? So,
So your argument is, again, what the Fed is actually doing is creating inflation.
Well, of course, that's what it does.
Which
Everything runs on debt. When you increase the price of debt, the cost of debt, you increase prices. Yeah.
I just have never heard anybody say it like that.
Well,
and I would agree with you, actually, because if you actually look at a long-term chart, when the Fed is raising rates, it actually, commodity prices typically go up.
Of course they do. Why would they do otherwise? I mean, seriously, you don't have to be a wizard. I don't understand why it's complicated. It makes me feel like am I on the outside banging on the glass going, what am I missing here? But, like I have right now, I have some Tiger Balm in my hand, because I use it for after jujitsu, let's say. And I mean, first of all, this stuff is made in Thailand, I think.
Yeah.
Manufactured in Singapore. And so there's transactions, right, to get this thing done. I guarantee you all those contracts are dollar denominated, first of all, because I've written them. And they don't want to be trading Singaporean dollars. Okay. I mean, Singapore is one of the countries, so it might be an exception, but in general, you don't want to do that. Certainly if it was in Thailand, they would be a US dollar contract. And so they're going to bear the currency risk of the baht going all over the place, so long as they can hold dollars. Okay, right. So there's your de-dollarization strategy goes out the window. But secondly, when does that guy get paid? Well, he gets paid like FOB. I mean, he gets paid when the product gets put on the container on the boat, right?
Right.
Which could be like 4 months from when he had to pay his people.
Right.
Where does that money come from? It comes from the bank. The bank just raises the price of that money. Guess what's happening? Cost of this is going up.
Right.
But so the traditional, and forgive me, I don't want to mischaracterize, but the traditional Austrian explanation that, the amount of money floating around is the reason this is going up because the demand for this has gone up. Sorry. No, I'm not going out and buying 9 containers of this because interest rates are at 0. That's not what's happening.
So how would you explain a Weimar Republic?
Everyone goes there.
I'm going there.
Yeah, political instability. February of 1923, the mark was trading at 4 to the dollar. October, it was trading at 4 million. The Weimar experiment in democracy failed. The increase in currency was a response to inflation, not a cause of it. That's what the Austrians don't get. The increase in currency is not the cause, it's a response. Right now, the Argentines have interest rates at 97%. They're trying to deal with inflation by raising the price of everything.
Right.
Think that's going to work?
No.
Why not? That's the strategy.
Yeah. That's never works in the past. And then they have a regime change and then they'll reset.
Weimar. Right. So Weimar and Zimbabwe and Venezuela, that's all about political instability. It's not about the proliferation of dollars. The reason you're using Zimbabwean dollars as toilet paper isn't because inflation is so high, right? So I think when people say the dollars create inflation, yeah, it's true for some assets that you can't accumulate enough dollars to buy it on your own. Mm-hmm. But for the ones you can, no, the dollars show up after the inflation. Yeah, and political instability is the main reason. So when you look at China and Brazil and India, like, have you ever tried to get US dollars out of India?
No.
Okay, I have.
Yeah.
Very difficult. Took me about 4 weeks to get a wire executed.
Yeah.
And they wanted to look into they wanted to reach into the transaction. It wasn't a KYC investigation. They wanted to look at the commercial transaction, the terms, the deal, before they would let go of their US dollars.
Interesting. Yep. Just delay, hold on to, delay, and then finally let go.
Well, and almost not let go at all. I mean, they bear with me for 1 second. You got the largest deposit of people around in the world, right?
Right.
And what's their economy? 2 trillion? I mean,
I don't know.
Yeah, I think it's around 2 trillion. It could be a little more. But the point is, they're not a threat. Not from a currency issuer perspective.
Right.
Right.
Well, where's you tell me then, where's the hole in your hypothesis?
Yeah, good question. It doesn't really sound right. How can it be that we can just print money forever?
Yeah.
Like, the question I always ask myself is, why do taxes matter at all? I don't think they do. It's not clear to me why it seems like they should, but they don't seem to. The government's able to spend more than it collects. Like, like how is this? If you,
that's probably limited to the U.S.
So no, it's not. It's not, which is why that proves the argument, though, right?
Right. That's what I'm saying. Yeah.
Yeah. That proves the argument. Like, if I was indebted to you $1 million, but every year I could pay you back 200,000, would you keep giving me money?
Of course.
Okay, you would. But would you keep extending my indebtedness?
No.
You might not. You might not. Now, if I could print the money, would you?
Yes, I got it. Yes, of course.
All right. That's it. End of story.
So I feel like we're like in the Matrix almost.
We are.
Yeah, that's what I feel like.
Yeah, we are.
There's a rational way, not a rational way, a proper way of doing things that we're not doing, but proper, that's, I guess, somewhat relative.
Yeah, I wouldn't use that word. I would say that so long as the reserve currency can be issued at will and people still want it,
right,
everything will be fine.
Everything will be fine. So let's go on those assumptions here. And as we're wrapping up, let's go on those assumptions over the next 5 years. I'll give you 5 years. And again, you're a short-term trader. I get that. But over the next 5 years, you would then put your money in US dollars or in US assets.
US 200%. I mean, if you're looking for pops, obviously go to developing economies. But so long as interest rates are high, developing economies are going to get murdered.
Yeah.
To the extent that they have dollar-denominated debt.
Right. And that's certainly been the case for the last several decades.
I think, isn't it Norway that has $1 trillion in the US stock market?
Norway?
Yeah.
In their sovereign wealth fund or something? I think you're right.
$1 trillion.
Interesting.
I mean, everyone looks at Norway and they're like, oh, Norway is so awesome. Sorry, Norway's sitting on a giant pot of natural gas. They have more oil than they know what to do with. They have 5.5 million people. They're one of the most anti-immigrant draconian countries in the world. And I don't know about inflation, but I know that everything's super expensive there. I paid $30 for a 6-inch sub sandwich when I was there. And the secretary makes $78,000 a year.
So the story about that is this was years ago. This was in 97. when I
Okay.
was backpacking Europe, we would stay or go to a country depending on the price of a pint of beer.
Yeah.
So in Czech Republic, a pint of beer was 10 cents to a quarter. In Norway, it was $10 to $15. And so we stayed out of Scandinavia.
Well, and the great thing about that index, right, is that it's mostly made of raw commodities.
Yeah.
So it's not a price maker, on most of its inputs. It's a price taker. And that gives you a good sense of the value of the currency relative to the rest of the world.
Yeah.
Yeah. Look, I'm not a genius. I don't have many answers, and I'm sure that there's a lot wrong with what I say and think. I'm not sure what that is. If I was, I would try to change it. I came to the market initially in the 90s, thinking that the kind of Austrian or quasi-Austrian way of thinking, a la, let's say, zero hedge, was the way to behave. And then over the course of a long time, I began to realize, or at least come to the view that, hey, wait a second, these guys can't predict the market at all, and they can't explain what's actually happening. And so when I think about broad economic theory, I wanted to explain what's happening at a minimum, and I wanted to predict what will happen at a maximum. And so this, the reason why people react to MMT, I think, is because it offends their view of the way the world ought to be. And they also can't consider it apart from the political recommendations and some of the apparent implications that you could just spin with abandon. So you have MMT folks that are on the far left or whatever. But for my money, I'm not talking about politics at all. The political questions about how we should allocate resources, to me, is in one sense totally separate. Now, on the other hand, I would say it gives us an opportunity to reinvestigate whether, maintaining and growing the military industrial complex is what we ought to be doing. We always have nearly $1 trillion for military, but we don't have $300 million for SNAP or whatever, or 300 billion or whatever it costs. So whenever it's a social program that's domestically oriented, the question is, how are we going to pay for it? But whenever it's foreign military spending, there's no question of that at all. And so it's not
because it's like, are you not patriotic?
Right. So it's not MMT that requires me to ask that question, but it is the consideration of MMT that got me to ask that question. Right. Which is, hey, the money is being printed in order to be given away. What's wrong with giving it to us? Mm-hmm. Right. So anyway, so I think people react to MMT because they're worried about what they think is a non-negotiable political baggage. And for me, they're separate arguments.
Yes.
In other words, it's mostly about the type of behavior you want to incentivize, and not so much about, quote unquote, whether you can afford it. You can afford anything.
Right.
On this model, you can afford anything.
Yeah.
Yeah.
Well, Rick, I want to thank you for your time, and we'll have you on again, hopefully in the next week.
Thank you,
this
Andy.
Was very stimulating.
Look,
I'm
interested in, before you let me go, I'm interested in the feedback of your audience and having a dialogue that sharpens my thinking, because I don't think I've arrived or that I know everything. And I'd be very interested in sort of, let's say, engaging the arrows that are shot at the heart of this theory.
Well, I wish I was better at that, but I'm thinking, and I guess it's not so much a disagreement with you. I'm just processing if that makes sense.
Yeah.
And I do see, I guess this probably the best statement is where I'm in agreement with you, and that's the dirty shirt argument. And when we talk about the dollar index, that's an index relative to other currencies, right? So
well, no. No, I mean it trades in dollar pairs against other currencies, and that confirms the dirty shirt argument. But I think let me just double check here. Yeah, I think you can look at the dollar index, the futures product, which is, in one sense, it's unavoidable that it's compared to others, but in this case, the DXY is an instrument that's not paired to another. Right.
Then what is it relative to?
Well, nothing.
It's relative to people who want it.
Yeah, this is just supply and demand, not relative to another currency.
Yeah.
Right. And just for what it's worth, January of 2021, it was trading. Let me see if I can get this. We might not have time. Yeah, my chart is screwed up, but let me see. 1, 2, 3, 4, 5, 6, 7, 8, like something like 16 months of going straight up. And that was at a time of unprecedented money printing. So that's the argument that debt issuance is dollar demand being borne out in real time.
Yeah. Well, my goal is to have somebody that has a different opinion on soon.
Yeah,
and
cool.
then maybe get you on together. So
Okay.
anyways, I'll let you go for now. I would love to have you on soon. And
Thank you.
Thank you to revisit this. But yeah.
Yeah, for sure. Let's do that.
All right. Thank you so much, Rick. Have a good night.
Likewise. Thank you, Andy.